Good day, Ira Epstein of Linn and Associates with your Spider ETF video, and this wrap-up is for Tuesday, and we're at the 20... Good day. Ira Epstein of Linn and Associates with your Spider ETF wrap-up, and this is for Tuesday, June 2nd, 2020, and we're about 5:50 p.m. Central Time. So another good day in the green for the different sectors. As you can see right behind me, they're acting fine. QQQ up, SPY, DIA, IWM, all the stock indices up. We saw pullbacks of nice size in the gold and the gold miners. Silver market down as well, and we're looking at the bond sector of the market down a little bit, the yields there. Now, as we take a look at the energy market, a bit of a rally. Remember, on the 4th of June, it looks as though Russia and OPEC Plus will all meet to discuss what they're going to do with production cuts. But remember, OPEC lets everything out of the bag before the meeting ever happens. So the consensus of opinion is that there's going to be a 30-day extension through the end of July on the current cuts. Supposedly, Russia claims that they've gotten down to the agreed amount now, so that would give them maybe a month at that agreed amount. The point that they're making, and I don't know that I disagree, is you're approaching $40 a barrel. Russia makes capital at $40 a barrel. It can't worry that Saudis want $85 a barrel. And yes, Saudi's budget, go read about it, was based on an $85 a barrel go around. Well, of course it is, because Saudi Aramco. You know, they're not going to come out and tell you $40 makes sense when they're trying to sell Saudi Aramco and force the sale down their major citizens, the really wealthy ones. We know what went on there. As we take a look at the tech sector, you can see how the market, not filling this gap, made one stab at it, didn't do anything. It stuck its neck out to another new high. Now, what we have done is we filled the gaps up here, I believe, but we've still got a series of gaps under the market. Doesn't mean they have to be filled, but it is something I pay attention to. The next thing that I look at is the tech sector. So in the tech sector, as we're looking at it with the swing line, what is it? Higher lows, higher highs. Bullish. So until the market takes out 96.23 in the tech sector, what do you have? A bull pattern defined as higher highs, higher lows. Where's the support within that sector? The 18-day average of closes. The dilemma is, to get back to that number, you'd have to go through 96.23. That means you'd break the pattern of higher lows, higher highs. Got to consider that. There are other moving averages if you get an embedded reading, and I'll explain that in a moment, that traders, I think, use, but I'll come to that in a minute. What about resistance? The upper Bollinger Band. Notice how this market has not wanted to stay over that black dashed line. So if the trade gets up there, and tomorrow that number's approximately 99.46, that is where I look for the traders to take some more money off the table. I mentioned to you momentum. It is locked in and bullish. That means that the red line and the blue have had now at least 3 days in a row where both are staying over 80. When that happens, until the red line closes back under 80, I look for the market to get bought on breaks. There's a moving average that I show in my Spider ETF video to my subscribers, and that's where it's discussed, not here. In the SMH, I always look at that and I think of soybean meal. In the old days, that was the symbol for it. March meal. But in looking at this, the upper Bollinger Band number is 144.38. We got up today to 143.71. We're embedded. I look for that number, just like it's done in the past, to be where the market runs into a grind, a problem, if you will. Now, a problem isn't bearish. A problem is where it maybe wants to back off. Frankly, this market and a number of them have been able to, for the most part, stay over the 18-day average since March. You've had a couple of small 3-day periods where it's gotten back under, and then it's reinforced the bullishness. In XLI, which is the industrial sector spider, I like this. And why do I like it? One of the reasons I like the industrials, I think the techs have had a phenomenal run. And I do believe in techs for decades to come. Don't get me wrong on that. But at this point in the cycle, where we're at in the economic cycle, I think industry is going to come back. I think factories are going to make money again. I think they're putting the people to work. We've all been hunkered down for almost 3 months. I think we're ready to spend on whatever products those factories make, and I think that that's what you're seeing, a certain amount of that. Now, the resistance in the market is the 100-day average of closes up to the upper Bollinger Band. Until you lose the embedded reading, I think that your market gets bought. Lose that reading, and if it stays lost on the close and the next day, I think you're going back to the 18-day average of closes from whatever price that happens at. Excuse me. On the energy sector, the API numbers that came out this afternoon, I saw them at 3:30. They showed a net build of 6-7 million barrels between a reduction in crude inventory itself and an increase in gasoline and distillates. Okay, that makes sense because the driving season's ahead of us. And if you think people aren't going to go driving, wrong. They're going driving. Have you gone out to look at an RV? They can't keep them on the lots. People aren't getting on an airplane for a 6-hour ride to Europe. You may think they are, they're not. Do you want to? Do you want to get in a subway system right now? You got your doubts about it. I was talking to our own company today as to what we do when the offices reopen. Who wants to come back to work? What do we do for all that? These are the problems. But getting in your RVs, getting in your family, saying, I'm going to go to the lake for 5 days. Can I rent a house? I'll drive there. That's what's going on. So please keep that in the back of your mind. In QQQ, well, obviously tech is still strong as can be. We saw today Zoom. I don't know if you saw their earnings and their sales numbers. Absolutely stellar. They're a huge winner on this. Why companies like WebEx and the others didn't do as well, I don't know. Zoom seemed to come out of nowhere, but it did a great job. And as I'm looking at this market coming up here into the upper Bollinger Band, I expect to see some resistance there. The emerging market ETF, it's alive. It's trying to break out. It keeps getting up to this upper band and just hanging there. It's not even pulling away from it. You'll know that there's a difference of opinion when and if the embedded reading lets go, it's time for a correction. It's not saying that. So as much as you might think this market's overbought, I look at it as just powerful as can be to the upside. In the gold market, we're having troubles. The gold market is just sort of wants to sit for a bit at this 18-day average of closes. Yes, the first challenge of the Bollinger Bands failed, as expected. Now what does the market do? Not sure. Over here, the first challenge of the lower band held. If you got down, yes, I would think 159.32 would support the market. I don't necessarily think we're going there. I think we're just sort of hunkering in now. In the gold miners, you reestablished a downtrend, and you'll say, how could that be? Well, yesterday what the market did is it closed over the 18-day average. So the market had a downtrend of lower highs, lower lows. You tell me the number it went to and found the support. Here's the market before that. Let me see if I can get it. There it is. Okay, we come down, we hit 32.54. The lower Bollinger Band's 32.63. If the market bounces, I look for the 18-day average to potentially be a resistance point. Market's playing around, gets there. What it did today is it tried a higher high and then came down. So, be it on Wednesday or Thursday, if this high of today is taken out, I think you lay a bear trap, and I think the market could possibly say, hey, I'm going to go back to the upper Bollinger Band. Don't take it out. You've got the bearishness set in, and maybe you're headed back towards that 32.90 level, the lower, if you will, Bollinger Band as well. In TLT, the market's drifting right here, back and forth, against that lower band. It did this before. Let's see what it does from here. Are we trending? No. Are we embedded? No. Oversold market in a support area. Certainly I'm not blind. I see it's drifting to the downside, and I see no reason to be long. Conversely, I see no reason to be short. In FXE, breakout to the upside. Came out of this broad band. It's not as tight as I normally like to see, but the breakout You tell me what you did. You're just carrying to the upside here. The market is anticipating that the European Central Bank this Thursday will offer something that the market wants to hear. We're already hearing Germany offering more. I was listening to Ms. Merkel, the Chancellor, today, talk about her idea of 100 billion euros to do something else in the marketplace. We know that France wants to get things done, but it's so hard to get 27 countries together and agree on anything, let alone spending money. That seems to be the problem. You know, if you like what I do here, you might like a lot what I do in the afternoon. Approximately 4 in the afternoon, 3:30, I start recording a special afternoon video, and this is for my subscribers on just spiders and ETFs. Now, I keep adding to it. I had a gentleman today I was talking to that wants me to add another one. I frankly didn't have the time to even look at it today, but tomorrow I'll give it my attention and see if they're there. We started with 27 charts. We're up to 30 some odd charts. I want to get near 40 in these. So I'll be adding them, but I won't add low volume ETFs or ETFs that people aren't interested in other than some select group. So that's already wrong. We can cross that out. We keep adding to it. And what I try to do is give you the fundamentals as to what I'm seeing going on. And I think you hear me talk about that to a certain idea here. Then points of entry, exact ones, exit points, stop out points, because I am going to be wrong. It's a guarantee. If you want a guarantee, I'll make bad recommendations. I knock on wood, I'll probably have a few winners. As you look at how this market plays itself out, these are the markets that I cover in detail. And the reason I cover it this way is just about all these ETFs are based on what the futures are doing in some way or the other. It's the spider sectors that differ. That's within the stock market itself, the different sectors. And you look to see how the ETFs are going to open to get an idea what the sectors are. Maybe I'm explaining that too easy, but it's what I've learned over the many years. To find out more, go to our website. Under the word research, everything is explained there. You can always call my staff. They'll be happy to work with you. I'm Ira. You have a great day, and I'll talk to you tomorrow.